Okay, so I think we covered the trend filter. So the next one is the chop filter. Now, what's the chop filter all about? We want to trade the trend, and everything's okay as long as we have a trend. But sometimes it happens that we enter a trade, and unfortunately, things start to flatten out. And that's not where we want to be for a long time. So we need some kind of ways to measure the market's momentum and somehow to recognize, of course, with algorithmic tools, with the software, if and when the market starts to transition into a sideways action. For two reasons. One is, first of all, we don't want to get new triggers, new signals in this area. So if we had long signals, let's say here, okay, well, maybe we got one more last one because there's always a little lag. There's incoming data necessary for the software to decide that we are now in the chop. Look back period is usually 20 bars. So we need incoming bar information from the market directly in order to calculate the point where we're going to switch off the signals. So the chop filter watches the market and recognizes when the market is flattening out and will prevent any more triggers in this area. And it's possible to switch off the chop filter, by the way. So it is possible to run two tests. One with the chop filter back test, let's say months or years, up to you, just a lot of trades, back testing, or even forward testing if you want, and just gather data and see what the results are if I include these trades in the choppy areas, which means chop filter switched off. And what results would I be getting if I do switch on the chop filter? Thereby, I'm going to skip these trades. I'm not even going to see the triggers because the triggers will be suppressed by the software. Now, in my testing, it's very beneficial, as obvious for most of us here. If you have traded for a while, it puts money in our pockets, or at least doesn't remove money from our pockets if we switch on the chop filter, because as trend traders, we don't want to enter trades in an area where the market is not going anywhere, most likely not going anywhere. Now, sooner or later, the market will do something else and will leave the choppy area behind. And first, we need to leave the area behind, at least have one initial momentum before the signals will be switched back on. So this is just a normal lag. And since the markets will be always here, never worry about missing a trade here. So it's okay to wait for the reemergence of momentum. We don't necessarily try to catch the first move. If you're lucky enough to get it or catch it, fine, happens to all of us. But as a usual business routine, we don't worry about the first move because we are after the second, third, or fourth. This is how the chop filter works. Now, what is smart here is the actual mathematical calculation. So in other words, what is the software looking out for and how does it calculate? And I think we have found a valid method to calculate the beginning and the end of the choppy period or area. Here we go. This is just a daily chart. And I'm going to remove the indicators, which we're not going to need for this little experiment. So converter, that doesn't bother me. Inside bar, doesn't matter. Okay, I'm going to remove these two at the bottom. So just to have a clean chart. Okay, and here's our usual chart with the usual ingredients. Okay, now let me show you the chop filter. So I'm going to go into the settings, and this is the indicator right now, but it works the same way with the strategy as well. Okay, so as usual, here's the chop filter, and it is switched on, and there is a sensitivity measured in ATRs. Remember, in our code, everything's measured in ATRs or standard deviations, which means not in a fixed measurement unit like, 20 centimeters or 1 foot if you're in the States. So it's not a fixed, rigid measurement unit, but it is one ATR, and one ATR is always whatever it is. You see, sometimes it's this long, sometimes it's that long. So it's self-adaptive. But we've talked a lot about that, so I'm not going to go through it. Just a little reminder that even the chop filter is self-adaptive. Okay, so I just use this standard settings of 0.5, which is half an ATR, and that just works fine for me. You're free to experiment with a stricter or looser setting. Let me show you how it works. So I'm going to switch it off. Let's start with a situation where there's no chop filter. So here, for example, this is obviously a choppy area, and here we have a signal. So these are the type of, perhaps even this one. So choppy areas is what I do not want to participate in. So I don't know what's going to happen here because I can't run the math in my head. But let's see if I switch on the chop filter. The question is, will those two, or at least one of these signals, disappear? We're looking at the signals, and I'm going to hit apply, all right? So let's see what happens. Here we go. So one of them is gone. So that's exactly what the chop filter does. Because in the settings, we can set it to take the first 100 signals. So if the trend goes on for 2 weeks, we're going to take lots of trades in the trend. Sometimes that's the way things go. That would work for most situations. And well, in my experience anyway, yours may be different, but by and large, second, third, strong. So if that's a healthy trend, you can get 3, 4, 5 good signals in the trend before you have to start thinking, okay, well, we may not want to push our luck. So, but this is all algorithmic, and I wouldn't really improvise when I trade. In my settings, 5 trades in a trend, and that's it. So let's say the first one we're not trading. So this is already the second signal in the trend. Second, third, fourth are the ones which are traditionally kind of strong. So if it's a healthy trend, you can get 3, 4, 5 good signals in the trend before you have to start thinking, okay, well, shall I take the 6th one? So number of signals, my default is usually 5. If you want, you can experiment with other settings. Next one is number of bars. It's very simple. Here, this is what I want to show you. The distance between 2 signals, the minimum distance. What we don't want necessarily is if I say 5 signals is allowed, I don't want to use up my 5 signals very quickly. So the software might just give me 2, 3 signals consecutively of a very little distance. But, this is basically the same move. I don't want to waste signals for the same flag or consolidation necessarily. So the point is, I can define a minimum bars which would be required between 2 signals. In my practice, that's usually 5. You can set it to 10 if you want, or you may not even use it. You want to just set it to 0, that's fine too, or set it to 1, then everything will be taken. No gap will be required between the signals. Force exit is, right, we touched upon it last time. So the way it works is that you go long on a beautiful bull flag, and then you're in the trade, and then the market does this. And it's just an hour goes by, bars, nothing happening, and you're long, let's say. And you're not stopped out, but you didn't hit the target either. So this is a situation where our capital is tied up. Okay, again, there's no obligation to use it. I can imagine that not every trader is interested in switching this on. That's perfectly fine. It's perfectly fine to wait and see what happens. There's nothing wrong with that. But the functionality is here if anybody's interested in thinking of using it or running some tests with and without it. So much about the force exit. Auto shutoff, as we mentioned in the past video, is for a situation where, let's say, just real life stuff, like let's say, I have a dentist appointment or it's midnight and I don't want to stay up at night, but I do want to enter this last trade, but I don't want to sit here for hours to see the result. And I don't want to sit here to switch off the machine or the strategy after I'm done with this trade. So what can I do? Auto shutoff says or allows us to define a number of trades which will be taken, number of triggers which will be taken before the strategy switches itself off. So it's not NinjaTrader, and of course it's not Windows or the computer will switch off. It's just the strategy will switch off. All right, now risk filter is a very advanced functionality. I do want to cover it. It's detailed in a written format in the documentation, but I do want to say a few things about it. So just price, that's it. And I'm going to put the strategy on the chart. And the strategy will allow us to, I'm going to go to BT because BT is the one that has it. BT and BTX has the risk management. ProSTR doesn't because ATM strategies in NinjaTrader, we can't connect to the brain. So we can only do this in BT. So how does it work? Here's risk control. The way it works is that it's just one line, but if you do switch it on, all the settings open up here. All right. First of all, you can be manual mode. Manual mode means that you have to enter manually the size of your account. So let's say I have a $30,000 account, 9 o'clock in the morning. I enter the 30,000 manually. And then when I activate the strategy, the software will do the rest and we will start with 30,000. That's one way of doing it. However, I can also do auto mode, which means, and this is really, really cool, which means that the software will automatically check the balance of the account and will automatically check the balance of the account after each trade. All right. And you can specify the account. It could be the SIM or it could be your live account. It will check automatically. You don't have to worry about it. And as it changes, so it will go with it. All right. There's a third one. Auto conversion is for traders who are not necessarily in USD. For example, they might be in Hong Kong, Japan, or Europe, euro-based trading account. So the account could be in euro, actually, something like this. And the instrument currency, if you trade the ES is denominated in US dollars, so there needs to be a conversion rate. And here, the conversion rate, that needs to be entered manually, right? So let's suppose that the conversion rate is 1.4. I enter that amount, and then the software will do the rest. Okay, so much about if the account is not in US dollars. But let's go back to US dollars because that's what I think most of us are trading on, a US dollar trading account. So in that case, auto just goes and checks the account. Most of the instruments that we trade are in US dollars since we trade US futures. So here's the settings. I'm going to show them to you. So first one is maximum risk of the account size that I'm willing to risk. So let's say I'm willing to risk 3% of the account. So if I have a $100,000 account, then my stop on one trade, one contract, one trade, or no, one full trade actually, doesn't matter how many contracts, is $3,000. If I set this to 5, then it's 5% of a $100,000 account. Let's say just to use round numbers, it would be $5,000 stop. All right. So you have to be reasonable with this. And of course, if I set this to 25% of the account, I would risk a quarter of my account on one trade. Well, it wouldn't take me too long to blow the account. So you obviously have to we have to remember or respect the mathematical realities of this job. We can't go to the moon with a bicycle. So be reasonable. I think professional traders do not like to set it more than 2 or 2.5. 3 is already a bit stretching it. Anybody can have 6, 7, 8 losers in a row, even the best traders. It can happen to all of us. It will happen if we trade long enough, even if we do everything correctly. So add that up. 8 times 3, that's already 24, 25% of the account. That's already a painful experience. So we don't want to set this number too high. So that's the risk as a percentage of the account size. And then the software will decide before each trade if we are below or above the limit. And the whole idea of the risk management function is that if the trade would violate your risk management rules, then the trade will be skipped. And you will not have the option to cause yourself trouble or harm, which means that you can't argue with your own settings while you're trading. The trade will not be taken. All right. Now, the traditional setting is also here. So at the same time, while you're setting this percentage value, you can also set a maximum gain and maximum loss as a percentage of the account. Okay, so this is the risk management. Again, it's very cool. Everything is run and recalculated before each trigger is taken. And this happens in a millisecond. So if I put this on the chart, let's just say, here we go. So now the account is active. If you get a green message, that means that if and when we get a next trigger, if and when I get a next trigger, I wouldn't get one because it's 4, the market is closed. But let's just imagine that on the open of the next candle, I get a long signal, a green message, and all the mathematics that you can read here. It just tells you that the next trade would be allowed. Now, if let's say I'm going to make the rule much, much stricter. So here we go. I want to demonstrate something. Max risk on the account. Let's say I say 0.1%. That's a very, very strict, not really logical risk management rule, but I just want to demonstrate something here. So I'm going to enable the account. And what I'm expecting is a red message here. Here we go. So red message, which means that even if the next trigger comes in, the trade would not be taken because taking the trade would violate the risk management rules that I set myself. Currently, no trades allowed. So this is very, very smart. I would say pretty unique. I haven't seen this apart from like professional big trading houses. So in retail environment, I haven't seen this, but we have it and you can have it too. And what would be the next one here? Auto reverse. Okay, that's pretty obvious. I don't need, everybody knows what auto reverse is. If you switch it on, let's suppose you're in a long trade. You're in a long trade and you're still in the trade. Market does this, and then you get a short signal here. Then auto reverse means that even if you have whatever your position is at the time, you might be in a winning trade or losing trade, whatever it is, the software would automatically get you out and go short. So it's like an always on the market strategy. Auto reverse, you abandon the trade you're in and you switch sides and you join the other side and you go short. If this is not switched on, then of course any short signal is ignored until you finish the trade with a win or a loss. So I think that makes sense. And last but not least, of course, the human filter. The human filter is a two-edged sword in trading, as we know. For most of us, I would say it could be beneficial to remove ourselves from the equation, from our own trading. And that's where algorithmic trading comes into the picture. So while I do maintain that there are situations where we have to manually switch or press the off button when we trade, it's not possible to code everything. So there could be situations where this button or if I was a trader, my boss would tell me, leave me instructions that if this happens, then press this button. And there could be situations where I'm supposed to press this button. However, most often, if I'm an algorithmic trader, obviously this would be switched on because most safeguards are in the program. And one of your job, if you are trading with BT, is to make a list. In what situations will I press this button? So much about the human factor. One challenge for each of us as traders to decide where we want to be on, remember this spectrum between, let's say, completely manual, doing everything with a club, with a stone, and doing everything with the most advanced computer. And none of us is at the two extreme ends, obviously. So most of us are somewhere in the middle. And during our career, we might move back and forth a little bit, but if we hang in there, and if we get a little successful, then probably we find our sweet spot where our business is just humming along nicely, and we are somewhere, let's say, a bit more algorithmic, but also not totally manual. So anyway, one challenge is to find your spot along this spectrum, and then define your rules, which are suitable for the spot you chose for yourself, or that seems to be working for yourself. So I think we covered them all. And again, this is all written down in the documentation. So feel free to think about them again at your own pace. Thank you, and mindful trading.